Burchett. He's the CEO at Risk Limited Corporation. They're an advisory firm advising commodities, forex, interest rates. Shannon, thanks very much for joining us. Let me ask you this question related to natural gas and crude oil first. Do you believe the fall in price is coming because a number of hedge funds invested in commodities need to make a quick exit, and there's perhaps a contagion going on, which means you sell natural gas and then you go on to crude and to something else? Could you tell us if that's the phenomenon in place right now?
Well, it could be a small factor in the price moves and volumes we see, but I think really it really is more a matter of the fundamentals in terms of what the inventory levels are and just the change in the pricing direction based on that. I think the markets are mature enough, and the volumes and the majors, certainly in the crude and natural gas, are high enough that it can absorb the unwinds by these hedge funds that have gotten on the wrong side of the market. So I think it could be part of the sentiment driving market, but I think it really comes down to the supply-demand fundamentals.
Right. Shannon, what is your view or your firm's view on the price, on the real price of crude and of, let's say, natural gas and some other commodities? And why is it that big hedge funds with very intelligent people like Amaranth get it wrong, or Goldman Sachs, which said that we are in for an oil shock and we should head to about 100? What happens here? Why is it that the same people with a great amount of intelligence get this wrong?
Well, that's the question of the day, I think. Clearly, there's some real talent in the hedge funds and in the energy portfolio management, but it's been the voguish area for investment in the hedge funds are looking for higher returns in this environment, and I think it's been easy money in a way that a lot of funds have flowed into the energy funds, the hedge funds. And so we're seeing a shakeout in some ways, and I think the recent episodes, $5 billion loss in a week or so, it exposes some of the weakness of the capabilities in some of the hedge funds. So there's smart money here, and there's some good talent amongst the hedge funds in managing on the commodity side. But I think we've seen a lot of money has flowed into some of the funds with maybe perhaps not without the scrutiny of what their capabilities are. And you've also had some turmoil in the funds for example, with the large losses this week that have been reported. There you had some of the people leaving the fund to start their own investment fund in energy. And so I think you had some of the talent going out the door in March and April at this particular fund. And that may explain some of the sort of shocking results of this. I think that the other thing that's most striking is that there's volatility in the energy, and obviously there's going to be losses that come with at times with some of the gains. It's just the level of losses here in this one instance would suggest that some of the controls and risk management capabilities you would expect weren't in place in this instance. And you also have prior to this, another large fund with headed by what was considered sort of renowned investors, a former head of the New York Mercantile Exchange, that sustained losses so severe that they were faced with shutting down the fund. So it's the question of the day. Right. How could this happen? I think it illustrates that there's going to be closer scrutiny of the management capabilities in moving into energy in going forward.
Right. The last time around the hedge fund industry took a knock was when there was a problem with the bonds, with the bonds of GM and with the bonds of Ford. Do you think this entire readjustment in energy prices could be having such a severe impact, or like we've been discussing, that this is just one-off and then it's going to be back to normal?
Well, I think I doubt we're going to see an exodus from energy investment by the investment funds. I think it's just going to be more selective. Investors are going to be more cautious in selecting the investment managers for this. The decline in prices, and clearly the trends are down. I mean, the losses were attributed primarily to natural gas trading in the North American market for the staggering losses of the $5 billion on this one particular fund. But generally, clearly the trend is down in energy prices, and both on the crude oil and oil complex. And I think we're closer to $60 rather than $80 on crude, and that's probably more to a new trading range we're going to see. And I think we could break that level, but at some point I suspect we'll see the OPEC, or primarily led by the Saudis, taking steps to cut production to try to maintain a trading range somewhere in the 50s or 60s. So we're in the down cycle, but one can make money in commodity trading whether the move is up or down. And I think some of the hedge fund managers have demonstrated that. They're, right now in the news we have the staggering loss for this one fund, but there are others that are doing well. In fact, some of the funds in the U.S. have been led by former Enron traders, and who were, even though Enron didn't fare well, some of the traders there were exceptional talents, and some of those hedge funds have done well in the energy market, even in this downturn.
All right, Shannon, we'll have to leave it there. Thanks very much for joining us. Shannon Burchett is CEO, Risk Limited Corporation, joining us from Dallas in Texas. All right, the U.S. Federal Reserve, its Federal Open Markets Committee met, said they'll leave interest rates where they are, but they made a couple of comments there, which we'll discuss. Joining us right now, of course, is Shailesh Shah, Senior Regional Economist at Credit Suisse, joining us from Singapore. And joining us right here in the studios is Pradisha Ganguly, Economist at Brick Securities. Thanks for joining us, Pradisha, and thanks for joining us, Shailesh. Let me just read one or two lines from what